Hey everyone, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, March 8th, 2025. I hope you're doing well. I hope you got a good night's sleep last night. Last week was definitely a rough week in the markets, and so I hope you're sticking to your trading plan, getting out when your stops tell you to get out of, and uh, it was a tough week, yeah, brutal week. The market, has definitely changed to a downside. My opinion, I think we're getting pretty close to a bottom, but I could be wrong. And in this podcast, we're going to go over some of those levels and why I'm making that case that we're more than likely getting close to at least a short-term bottom. But you never know, right? I'll make my case, but it doesn't mean that it has to be true. So appreciate you coming to my weekend review podcast. I think today is going to be a good podcast because we have a lot of um, different positions that I got in, got out, some good, some bad, but I think it's a good learning, teaching opportunity for all of us because, for so many months, things just went up. Um, I laugh when people say, oh, people that buy puts are stupid and the market's never going to go down again. I actually literally heard this stuff. And look, market's vicious. It can go up, it can go down, it goes up farther than you think, it goes down farther than you think. So, anyway, just be careful out there is what I'm saying. So here is the format for the podcast today. First of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the positions and all the trades that I made last week, and there's a lot of them. And we're going to talk about when I entered the trade, why I entered the trade, what the setups were, what the confluences of the signals were. We're going to talk about where I placed my emergency stop, my end of bar stop, how I'm going to take partial profits, how if it gets to certain levels that I will tighten up my stop, and then ultimately how I'm going to get out of the position, out of completely all the positions. So when I entered, why I entered, and how I am going to manage the trade going forward from here. After that, we're going to talk a little bit about trader psychology. The most important skill in trading, everyone, is the ability to create a plan and follow it, whether the outcome is good or bad. Obviously, we want good outcomes, but in reality, we're going to have a lot of losses along the way, and we need to keep those losses small when we're wrong, and we need to have a process that allows us to stay in and have larger outsized gains occasionally when we're right to pay for all those little losses. So I like to talk about trading psychology. It's helpful for me to teach. I hope it is helpful for you to learn. And this kind of environment, um, trader psychology really is super important. After that, I have gone down through my master watch list. I do it every Friday night. And I have identified some potential trades for next week, both on the daily time frames and the weekly time frames. Those markets are not where they need to be yet, but I've identified some levels and confluences of support and resistance for short positions that if and only if those markets get to those levels and react in the way that I need them to react, then I would consider taking the trade. So I think I've got some good ones. And like I said, they're not where they need to be, but they're close. And next week, if we have a turnaround and we get to those levels, then that'll be a really good price. But I could be wrong. Keep that in mind. I could be wrong, and they could turn into losing trades. So anyway, like I said, I hope this is going to be helpful for you. It's a good week to do some study on. If there was any week, this is the week. And so if it is helpful for you, I would appreciate it if you could hit the thumbs up button, subscribe to the channel. It really helps out the channel, lets YouTube know there's some valuable content here. So with that, let's run the U.S. legal disclaimer, get that out of the way, and then we'll get started. So hang tight.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get started on my current open positions. Now, I'm very grateful that I have this trade. This is VIX. I use and I teach 7 different strategies, and so I have multiple different strategies that you'll see today in the current positions that I have. But the first one off the bat is called a bullish order block. This is this green box down here. Now, this green box, the order block, goes all the way back here to July of 2024. This is what I'm keying my trades off of. And I know this is probably a little difficult to see, but this created the order block. And look what happened every single time we got to the order block. We rallied strongly, and we rallied strongly here as well. And I'm very grateful to be in this trade, especially within this time and this type of environment. Sorry, my computer, on top of everything, my computer crashed last week, and I had to get a new computer and load everything up and redo my charts and the whole deal. And so, boy, it has been quite a week, I'll tell you what. And so I had to mark up all my charts again, and I'm glad I had a copy of them. So anyway, here we go. I entered VIX on the 20th of February. Why? Well, first of all, we came into the green area. We came into the order block. Second of all, we had a V1. V1 consists of 2 bars, bar 1, bar 2. Bar 2 went under bar 1's low and closed above the close. So I got long here at 41.40. Now, as soon as I get, well, let me tell you a little bit about position sizing here. So let's do that first. So when you have an entry, like I did here on the 20th, the first thing you have to decide is how many shares am I going to buy, right? Position sizing. It's very important. And the rule and the methodology that I use consists of 2 things. How much is in my trading account and what is the value of the 2 ATR? For me, that's all I need to know. So generally, I use a 1% position size. So let's say I have a $50,000 trading account times 0.01. Of course, that's going to be $500. If you have a $100,000 trading account, it's going to be $1,000. If you have a $1 million trading account, it's going to be $10,000. Okay, but only 5% of the time are you going to actually hit that emergency stop. And again, I'm using 50,000 times 1%. So I take $500 and I divide it by the value of the 2 ATR. This is going to change every day, but right now the value is 538 divided by 538. That's going to tell me to buy 92.9 shares. I'm just going to round that up to 93. Okay, so I have my setup. I have my entry signal, which is the VIX came down into the bullish order block. We have a V1. I got long at 41.40. So I take my entry price and I minus the value of the 2 ATR that I just did the math with over here, and I put the emergency stop down here. So if I have 93 shares and it goes down $5.38, how much do I lose? I lose the $500. But the good news is that only happens 5% of the time in my experience. The other 95% of the time, if I have a loss, it's going to be my end of day stop. And right now, based upon this trade, when I entered the trade, my end of day stop is simply a close below the green box, which is the low of the order block here at 410. All right. So the setup was the price came into the bullish order block. We had a V1 entry. I entered at 41.10. I position size like I just showed you. I placed my emergency stop 2 ATRs below. and my end of bar stop's a close below the low of this order block. Even if it had closed 1 penny below, I need to get out of the trade. Okay, now the next thing I do, once I have my emergency stop, I know where my end of bar stop is, I've entered the trade, I take my entry price and I look at the value of the 1.5, which right now is 403. And again, this changes every day as well. So I take my entry price, I draw a line, I just add the value of the 1.5 ATR for my entry price up, and here this is my entry price plus 403 or whatever it was at the time that I took it, and this is my emergency stop. So all this, my trailing stop level. Sorry. So all this is if I get to my trailing stop level, just 1.5 ATRs above my entry, I am going to go into trailing stop mode, which means that if I have a close below a previous bar's low, I'm going to exit half. Okay? So everything I've talked about so far, how to position size correctly, where your end of bar stop is, where your emergency stop is, where your trailing stop level is, these are all defensive maneuvers. Or in other words, if the market goes against me, I am going to do this. I'm going to take this action. But I also like to play offense in my trading. And playing offense means I take a partial profit if the market that I'm trading goes up a certain amount from the previous day's close. And I place 3 profit targets every day. And so I am in this trade. So I'll give you an example. And it's quite easy. You just look at the closing price. Right now the closing price is 51.23. I just look at the closing price. Then I look at the value of the 0.45 ATR, which is $1.21. So I take 51.23 plus 1.21. 52.44 is my first profit target for Monday. I just put a limit order in for 10% of the amount of shares that I have going into that day. So, you know, if I have 100 shares at the moment, I would place a limit order for 10 shares at that first profit target. Then I take the first profit target, 52.44, I add the 0.45 to it again, plus 1.21. I have another profit target, my second profit target at 53.65 for Monday. And I do it one more time, 53.65 plus 1.21. My third profit target for Monday is 54.86. And again, what do I take off at those 3 levels? 10% of how many shares I went into the day. So if I'm going into Monday with 100 shares, I have 10 at the first, 10 at the second, 10 at the third. Now, if it goes down, I'm not going to hit any profit targets. It may go up, hit 1 profit target, maybe 2, maybe 3, but it's important to me to play offense and defense, everyone. You have to play defense, obviously. That's your position sizing, that's your emergency stop, that's your end of bar stop, that's your trailing stop level. That's if we reject, like a 70 RSI, something like that. These are all defensive, but offense is taking partial profits into a strong move. Make sense? So let us kind of start from the beginning. There we go. Okay, so kind of explain the offense, the defense, and so forth. So let's just kind of do a recap now, and then we'll get into all the specifics. So we came back to the order block. We have a V1. That's the entry signal. We position size. We place our emergency stop 2 ATRs below. Our ended bar stops close below the low of the order block. We place our trailing stop level 1.5 above, and I'll show you here as we go along that we took partial profits. Next day after I enter the trade, big blast off, obviously hit multiple profit targets. Next day, we go into trailing stop level because we got to 1.5 ATRs from the entry price. Doesn't mean we do anything, it just means we're in trailing stop level. The next day goes up again, I hit another profit target. Next day comes down, but does not close below the low. Otherwise, I'd sell half of the remaining shares. And then we just move up and up and up. Profit targets, profit targets, profit targets, profit targets. Now here on the 4th of March, I exited half the position. Why? Because we got up to the 70 RSI intraday, but we rejected it and closed below. That is a signal to tell me to take some of the profits off. So on Tuesday, I took half of the remaining shares off for a gain of 18.07. The next day went up a little bit, closed down. Of course, Thursday was the big, huge down day where VIX, of course, is going to go up. And so I hit multiple profit targets there. And then Friday we were up but closed a little bit lower. So on Tuesday, I did take off half of the remaining shares I had for a gain of 1807, and the remaining shares that I have here currently up 19.29%. So it's really nice, you know, if you've been listening to this podcast for a while, you'll remember that I said when the VIX gets low into these order blocks, most likely the market is going to turn down and VIX is going to go up. And it happened again. We got here, you know, the VIX is going down, the market's going up. As soon as we got here, that's when the market fell and you had a big spike in VIX. And then we got here to it again, that's when the market fell. Then the market started going back up, and then here, I distinctly remember here saying, be very, very careful with your longs, everybody, because VIX is here and most likely going to bounce. And if it bounces, the market's going to go down. I had no idea that the market was going to go down as swiftly as possible. But that is one of the reasons why I took this trade, because, you know, I felt like the market was high. The technicals were telling me the market was high and VIX was telling me. So anyway, I'm very grateful to have this trade. Now, how do I get out of this trade for good? Well, if I get to a 65 RSI level, right now we're at 62, but you can see during the day we were at like 72. If I get to a 65 RSI level or higher, and then we close below the 5 EMA, this is this thin blue line here, then I will completely exit the position. And, you know, obviously, for all of us, I hope VIX does close below the 5. I can get in. Very happy I took the trade, but that will be a good sign for the market. If VIX can lose the 5, then more likely it will head back down lower, and more likely the market will head back up higher. But I could be wrong. But anyway, really great trade on here. Again, locked in 18.07% on half the position, and the rest of the position that I currently have open up 19.29%. Okay, let's go to IBB. IBB, this is the same as VIX, but instead of a bullish order block, it is a bearish order block. And here you can see, here is the red order block. What makes an order block? Here on the 5th, we had our highest up bar close before we change market structure to the downside. Once you change market structure to the downside, I'm looking to short any rallies. And this is the short that I took on the 21st of February. We rejected the bottom of the order block, or in other words, we rejected the red box. We also rejected the 200-day moving average. We had a bearish V1 to the downside, and there we go. So I got short here at 138.90. My emergency stop is 2 ATRs above. My end of bar stop is a close above the high of the order block at 142.60. I placed my trailing stop level 1.5 ATRs below my entry because I am short. And then, of course, I take partial profits if the market moves my way. Next day, didn't do much. Next day, we moved down, so I took some partial profits. Next day, moved down, took some partial profits. Next day, moved down, took some partial profits. Next day, opened down, reversed back up. But what's interesting about this particular day is I got to trailing stop level, which, because I'm short, means that in the future, if I have a close above a previous bar's high, I will get out of half. Next day, opened up, but then huge down where I took more profits. Next day opened up down, went down, took more profits. Here on the 5th, I have my first close above a previous bar's high after reaching trailing stop mode. What did I do? I took off half of the position for a gain of 2.32%. And then Friday we were up a little bit as well. So I didn't hit any profit targets. And the remaining shares are currently up 1.45% on this short trade. And again, this is a bearish order block. We've got a lot of signals to go through today, everybody. BABA is the next trade. BABA is a different strategy that I use and that I teach. This is called an abandoned baby. An abandoned baby consists of 3 bars where you gap up and then immediately gap down. And the key to this strategy is the quickness in how the sentiment of the market changed. On this day, we gap up. Things are very bullish at the open. And then right after we gap up, we immediately gap down. This indicates to me that in the future, this market is going to be lower. So I don't short it right here. I waited for a check back up and a rejection of the bottom of this baby. And by the way, if you want to learn more about abandoned babies, go to my YouTube channel in the playlist. I have a good video there that explains abandoned babies and island reversals. Island reversals are very similar to abandoned babies. It's just they consist of 2 or more bars, where an abandoned baby just consists of 1. So many times after this gap up, gap down, you'll have a little bit of a check back, and that's exactly what happened. We checked back, rejected the bottom of the baby. I got short here 139.20. With this particular setup, my profit and loss is a little bit different. This one's a little bit simplified. All I do is I position size like I normally do. I place a 2 ATR stop above me and a 4 ATR profit target below me, which is correct trading, because you want to have asymmetrical risk, meaning that you stand to win more than you lose if you're right. And with these abandoned babies, more often than not, I'm right. Like 70+% of the time, I'm going to make twice as much as when I lose. But about 30-something% of the time, I will lose. But when I lose, it will only be 2 ATRs. When I'm right, I'll make 4 ATRs. So it started off really perfectly. Now we've had a little bit of a rally, but what I'm saying is this is a set it and forget it type of trade. So I'm either going to hit my emergency stop 2 ATRs above for the loss, or I'm going to hit my profit target 4 ATRs to the downside. And currently this particular trade is down 1.17%. All right, let's go to AMD. All right, AMD, this is a good example of combining 2 different strategies. Remember, I use and I teach 7 different strategies, but when I have a confluence of signals, the best trades for me happen when I have 2 different strategies that kind of meld into one. And this is exactly what happened on AMD. So I did get long AMD here at $100.50. And let me explain the reasons why. Well, you see the green box here. The green box is an order block, okay? A bullish order block this time, just like on VIX. And this order block goes all the way back to, wow, is it way back here? All the way back here to 10/30 of 23. But these order blocks, more times than not, have memories. So all the way back from 23, going here into the future. And here we are in the order block. Now, the reason I took the trade was a combination of 1, being inside the bullish order block, 2, that we have this channel line where I connect the bottom here, I connect the bottom here, I go out into time. This is an area when it achieves this channel, very likely you'll have a bounce. That happened, but the reason that I got into the trade was a deep dip buy under 30, over 30. So I combined the order block with the under 30, over 30. During the previous day, we closed under 30 RSI. On the day that I entered the trade, it closed above 30 RSI. And if you've taken my deep dip buy course on Udemy, or you've been one of my students, you know that's what I teach, under 30, over 30. But again, I don't like to just take one signal. I'd like to take multiple signals, and there were multiple signals here. One, you're in the bullish order block. Two, the previous day you closed under 30, over 30. Three, we rejected this downward trend line or channel line, and I did get long at 150 cents. Does that make sense? So now I have to decide, okay, what's my emergency stop? Where's my end of bar stop? And how I'm going to manage the trade. So I got in at 150. Of course, I position size correctly. I placed my emergency stop 2 ATRs below as always. My end of day stop or my end of bar stop is simply going to be a close back below the 30 RSI, because that's really what got me in the trade in the first place. And right now we're at 35.70. So it closed at 35.70. It did not close back below 30 RSI. So therefore I am still in the trade. Orange line up here, what's that? That's my trailing stop level, 1.5 ATRs above my entry. So this trade is basically even. I mean, technically, it's down 0.15%, which I'm grateful for that, right? Especially for this week. But I am encouraged by this trade because we had a V1 on Friday, which means the V1 consists of two bars, bar 1, bar 2. Bar 2 went under bar 1's low, closed above bar 1's close. So for me being long AMD, the relative strength of AMD is quite strong because it hasn't gone down in the last week like the rest of the market has. So, and we had a V1. I wouldn't take the trade just based upon the V1, but it helped strengthen the bullish case that it tried to go lower and reverse back up. So down 0.15% on this trade, but really good teaching example, really good example of multiple confluences. One being in the bullish order block, two, the under 30, over 30, three, the rejection of the channel line, and four, the V1, because look, we went below bar 1's low, closed back above. So slightly down on the trade, but good example of these confluences. And by the way, you know, like I mentioned, I do use and I teach 7 different trading approaches. I've taught students from all over the world. I have a one-on-one course where I teach my students, you know, one-on-one. It's a 15-hour course. It's a serious course. Each session is 3 hours. I teach 5 sessions. Want to say hello to Pete and Steven. Currently, I'm teaching 2 students, and I enjoy that, and I hope they're going to learn a lot. But if you are interested in working with me and have me teach you one-on-one all the strategies, all the rules, my email is in the link of this YouTube video. Just send me a email, and we'll get the conversation started. But I love to have you as a student, and I'll teach you everything I know from my 30 years of experience in trading. So, yep, AMD down 0.15%. All right, let's go to Caterpillar. Caterpillar, a bright spot in the rain. Again, you see the green box. What does that mean? It means bullish order block. So a lot of times I take a trade with the rejection of the top of the order block, but on March 4th, I did enter Caterpillar because it rejected the bottom of the order block instead of the top of the order block. And this has been a really good trade so far. I've been watching Caterpillar very closely because I knew we were getting into the order block range and I was looking for some type of entry, but I got the perfect entry on the 4th of March. Why? Because we went below the order block and closed back above it. So I got long 326.70. I position size correctly. I placed my emergency stop 2 ATRs below. And on this trade is a perfect example of a very good risk to reward ratio. It's just a close below the low of the order block. The stop is 325.60. I got in at 326.70. So, in the future, had we closed at 325.55, I simply would have gotten out with a very small loss, potentially, right? Could have hit my emergency stop too. But thankfully, it didn't do that, and it has been bucking the trend of the market. And so I placed my trailing stop level up here at 339.80. The next day, moved up, hit profit targets. Next day, didn't do much, was up a little bit, but I did get to trailing stop levels. So now in the future, if I have a close below a previous bar's low, I'm going to get out of half. And then on Friday, had a stellar day up where I hit multiple profit targets. So I took off strength here, I took off strength here. I am at trailing stop level. So Monday, for some reason, if we come back down and close below a previous bar's low, then I'll exit half. But once you reach trailing stop level, a lot of the pressure's off, right? Because one, you had to go up a certain amount to get there. And by doing so, you took off, some of the position. So it's a lot easier to breathe. But this has been a really wonderful, great trade. Currently, from the remaining shares that I have, up 6.67%. And the relative strength of this market is very strong because it's going up when the rest of the market's going down. But a good example of getting in when you reject the bottom of the order block, gain of 6.76%. Let's go to Google. Google has also been a really good example of confluences of signals. You see the green box, that's going to tell you that is an order block, okay? As soon as I get into an order block, I'm looking for some type of entry signals. When I was teaching this last week, I taught my student Stephen that no, excuse me. This is with somebody else that I consult with, but I really like the idea of multiple signals inside the order block. And this is a combination of an order block in the green and a deep dip buy, right? Which I've been talking about a lot, deep dip buys. What's the deep dip buy? Well, it was here on the 3rd of March. It was a rejection of the 300-day moving average. At the same time, it was in the bullish order block. I got long 167.20, placed my emergency stop 2 ATRs below. My end of day stop is simply a close below the 300. That's it. Even 1 penny, I would just get out. I could get right back in if it goes back above. But these last 2 trades, really good risk to reward ratios in an important level like the order block. So I got long 167.20. I placed my trailing stop level 1.5 ATRs above. The next day, it did move up nicely, and I was able to take off some profit targets. Next day, moved up again, 1 profit target. Next day, down a little bit. And then on Friday, we were up again, and I did hit another profit target near the top. So interesting position. I'm glad to see Google was relatively strong compared to the rest of the market. It's kind of bottomed here when the rest of the market was going down. That shows relative strength. And the remaining shares that I have on this position, on the Google position, gratefully up 3.83%. All right. Let's go to the last open position. I did enter this position on Friday. Again, this is a combination of different trading strategies. One being the order block because you see the green box, and 2, deep dip buy, right? The deep dip buy strategy. Why the deep dip buy strategy? Because we had an intraday rejection of the 200-day moving average, which is the black line. And all that means is during the day, we went below the black line, the 200, which is a very important level, but yet we were strong enough to close back above it. So that's your deep dip buy. In addition, here's the negative third ATR channel. 92% of the time, when price gets to the negative third ATR channel, it stops going down or it starts going up. And on Friday, same thing. Not only did we intraday reject the 200-day moving average, but we also rejected the negative third ATR channel. And on top of that, it happened in a bullish order block. Yeah, makes sense. And by the way, if you'd like to learn more about the deep dip buy, I mean, obviously, if you take the one-on-one course with me, I teach you it step by step, but I also have an online video course available at udemy.com, and that link is in the description as well. It's very affordable. It's 9.5 hours of video, and I've sold so many of those around the world, and this is a perfect time to take that course because we are in deep dip buy levels right now. We are in deep dip buy land. And here on Friday, I took this trade. This is an actual trade that I took deep dip buy. And in addition to the deep dip buy, the rejection of the negative third ATR channel, the bullish order block, we also had a V1. Bar 1, bar 2. Bar 2 goes under bar 1's low, closes above bar 1's close. So this is really a high conviction trade, right? The score is off the charts on this particular trade on the SPY, on the S&P 500. Doesn't mean it has to work though. It doesn't mean it has to work. This has been a crazy market, but I know exactly what I'm going to do regardless of what the market does. And that's what you need to have in your trading. You need to have if-then statements. If it does this, I'm going to do that. If it does that, I'm going to do this. Color by numbers. I'm telling you, I've traded for 30 years. If you do this, your trading is going to be better. What are what are the potential situations next week? Next week, I have my emergency stop. Maybe the market just opens up, goes down like crazy. If it does, I hit my emergency stop. I'm out. I lose 1% of my account. Second option, it goes down a little bit, but it stays above and closes above the 200. What do? I stay in. Third option, it goes down and closes below the 200. What do? It's my end of day stop. I get out, right? What about if it goes up? Well, if it goes up, what's the 0.45? 383. If it goes up 383, I take off 10% of my position. If it goes double that, I take 20. If it gets up all the way up here to my trailing stop level, then I go into trailing stop mode, right? If it keeps going up, gets to 65 RSI level, then the 5 EMA comes into play. So it's very easy. It's not difficult to set these things up. Really, it's not. But what's difficult is to do what you're supposed to do. It's pretty easy if it goes up to do what you're supposed to do. But if it goes crashing down, you'd be like, but I don't know. I think just follow your rules. I'm going to. If it closes below 200, I'm out. If it hits my emergency stop, I'm out. So anyway, I got in on Friday here at 575.20, and I mean it's up a little, not much, up 0.15%. So those are the potential, or those are the current open trades. VIX remaining shares up 19.29%. IBB short remaining shares up 1.45%. Alibaba, the short on Alibaba, down 1.17. AMD down 0.15% on the long. Caterpillar up 6.76%. Google up 3.03%. And SPY, the new trade on Friday, up 0.15%. So really not bad. And the only reason I am in these positions is because they're moving my way. Now, I have 4 other trades that did not move my way, but the key is I got out and I got out quickly. That's the key. Staying in the trades that are working, getting out quickly of the trades that are not working. Being patient with your winners. I'm patient with these guys. Being impatient with your losers. These did not work for me. I got out. That's it. Patient with your winners, impatient with your losers. So now let's take a look and go over at the trades that I had to get out of last week. Okay, so these are the closed trades that I had that I closed sometime during this week. And you will see that they were good setups, they just didn't work. So I entered CRM, Salesforce, on the 5th of March at $291.80. What was the setup? It's a really good setup. It was under 30, over 30, and a close under, close over the 200 and a close back over the negative third ATR channel. This is a triple A rated setup, but like I mentioned before, that doesn't mean it has to work. So I got long 291.80. I placed my emergency stop 2 ATRs below. I placed my 1.5 ATR trailing stop level, 1.5 ATR above. The next day started out great. I did hit one profit target, thankfully, but on that same day, it came back and closed under the 200. What was my end of bar stop, my end of day stop? Under the 200-day moving average. I simply got out, right? I was impatient with my losers. I followed my plan. My plan told me to get out of the trade if it closed under the 200, even though it was a AAA rated buy signal. Am I glad that I did? Yeah, because look what happened on Friday, down even more. Look, I can always get back in this if it closes above the 200-day moving average, but my rules told me to be impatient. And you know you're a good trader and you're on the right track when you're in one day and out the next. You're not playing games with yourself saying, well, I'm going to get out here and then it's going to go right back up. We've all been there, right? Follow your rules, follow the price action. You will do better. Doesn't mean I can't get back into CRM again. Maybe I will if it closes above the 200-day moving average. But for now, there are no more buyers wanting to be in above the 200. So a one-day trade, a loss of 1.93%. But I'm glad that I followed my rules, right? It was the right thing to do. And I can always wait for an entry back over. And, when you have this strong of a signal and under 30, over 30, and under 200, over 200, and a rejection of the negative 30 ATR channel, I got to say, I was surprised when it closed underneath. But I want to trade for a long time, so I need to follow my rules. Get yourself a process, whether it's me helping you learn the process or someone else, get yourself a process, and by all means, follow that process. So down 1.93%. Tesla's been having a tough time with it. Same kind of situation. I did get long Tesla on the 28th of February with an intraday rejection of the 200-day moving average and a V1. I got long 287 even. The next day it did gap up, which I was very grateful for because I hit another profit target, right? So that minimized my risk or my total loss because I took 10% off here at a profitable level. But it sold off during the day, but it still did hold the 200-day. It closed above the 200-day, so I kept the trade. But then on the 4th, I had to get out of the trade. Why? Because it closed below the 200-day moving average, and I had to take a loss on that of 4.76%. Kind of a bummer, but I have to follow the rules. But am I glad I followed the rules? Yeah, because look what happened the rest of the week. It went down double that. We did bounce here at the 300. Maybe that's good. We're still under the 30 RSI, but Tesla's having a tough time of it. And I can always get back in Tesla. But again, I got out because I had the proper signal. But then on the 4th, it closed below the 200. Regardless of what I think or what my opinions are, I have to get out of the trade. I had to get out of the trade for a loss of 4.78%. Qs. Okay, another example of getting in and out. I did get long the Qs here on the 27th of February. Why? Because it rejected the bottom of the order block. I got long at $500.30. Placed my emergency stop, placed my 1.5 ATR trailing stop level. Where is my stop on this trade? Well, it's a rejection of the order block, just the bottom of this green box. Next day, started moving my way, hit a profit target. Next day opened, hit another profit target, but then it closed below the low of the order block and I had to get out for another loss of 0.66%. Not bad, not too bad, but am I glad that I got out and adhered to my rules? I did, because all it's done is go down and down and down. Now look, we have another order block, lower order block, that we rejected the high of the green box, and we had a V1. It's a good sign, but I'll talk about the Qs and I'll talk about the S&P a little later in the podcast. But this was an encouraging sign that we were down on Friday but reversed back up. So, but the trade, the earlier trade, down 0.66%. And then last but not least, NVIDIA. I did get long NVIDIA here on the 3rd of March. Why? Because it rejected the bottom of the order block. I got long 114, my emergency stop, 2 ATRs below. My end of bar stop, a close below the order block, 1.5 ATR trailing stop level above. Next day, took off, went up, luckily, hit some profit targets, took that off, then hung around here, and then here on Thursday, it closed below the low of the order block, so I had to exit the trade for a loss of 2.63%. So I don't make money on every single trade. This is a good example of that, but it's not important whether you make money or lose money. It is important whether or not you follow your rules, and I am following my rules, both on my profits and on my losses. Maybe Monday it takes off, roars. Am I bummed that I got out? No, I'm not, because I have other longs, right? I have other longs, but it's just, again, the importance of following your process. I know if I follow my process in the long run, I'm going to make money. If I'm chasing money, trying to make money, that's when you lose money. So those are the closed trades, the closed daily swing trade. CRM, loss of 1.93%. Tesla, loss of 4.78%. The Qs, a loss of 0.66%. And NVIDIA, a loss of 2.63%. So over here, the open trades, doing nice. Had a good week with those. The closed trade, didn't do so great with them, but I got out quickly. That's important. Okay, let's go to the current weekly trades, and we're almost done. So these are weekly trades. I take these trades on Friday. I did get long TLT. You see the green box. Again, what's a green box? It's an order block, but it's an order block on the weekly time frame. I got long TLT when we rejected the order block, closed back above it. We also had a V1. I got long here, 87.20. Placed my emergency stop 2 ATRs below. My end of bar stop on this one, sorry, because my computer went out and I had to redo all my charts. My end of bar stop, simply a close below halfway of the big up bar that I took here at 86.20. Placed my 1.5 ATR trailing stop level above, and it's been a good trade. Started off, went up, down. Then we had a big week here where I did hit a profit target. Then we moved sideways for a couple weeks. Week before last, had a big up move where I hit multiple profit targets, and I'm also in trailing stop mode. So now if I have a close below a previous bar's low, I would get out of half. Had we closed this week below this bar, that would be a close below a previous bar's low after reaching trailing stop level, but it did not. So I am still in the trade, profitable on the trade here. Current up 3.21% on bonds, TLT. And then last but not least, DDM, which is double leverage Dow, which I was short, and I was glad to be short. Why? Bearish order block. Why is it a bearish order block? Because we have the highest up bar close, then we change market structure to the downside. If I change market structure to the downside, I want to short any checkbacks or any counter rallies. I got short here the 31st of January when we rejected the bottom of the order block, which is the bottom of the red box. I got short here 103.70. My end of bar stop is a close above the high of the order block at 107.53. My emergency stop is up 2 ATRs up here. I placed my 1.5 ATR trailing stop level to the downside. And then I take partial profits if I get them. Next week, again, I got short 107.30. Next week, hit a profit target. Then we rallied. This week, hit multiple profit targets to the downside, right? So I'm taking off as the market's going my way. Week before last, we no profit targets, we went up. And then this week, I hit 3 profit targets to the downside. And now I'm also at trailing stop level, which means now if we close above a previous bar's high, I'm going to get out of half. But this has been a really good trade. Glad to have it. Currently, this particular trade up 8.6% on the short side. So that's it on the weeklies. DDM, the short, up 8.61%. TLT, the long, up 3.21%. All right, so a lot of positions there. I hope you understood them. If you don't, if you have any questions about any of them, feel free to put them in the comment section. I'm happy to explain further of why I took this trade and why I'm managing. But all in all, actually pretty good week considering, right? Because I got out of my losers quickly. I'm staying in my winners. And that's what it takes. All right. All right, let's talk a little bit about trader psychology, and then after that, we are going to get on to potential trades for next week. This comes from my good friend and mentor, Stephen Burns. Steve is a great author. You can check out all of his books on Amazon.com. Read all of his books. You're going to learn a lot. A lot of what I use and what I teach stems from Steve Burns, combined with the other methodologies that I use. But let's see what Steve has to say. And you can follow Steve at @SJosephBurns on X. So big profits often emerge not from constant activity, but from patient waiting for the right time to act. You know, a lot of people that want to trade, they're kind of A-type personalities. They feel like they need to get in there and do something always. It's not the right way to think about it. You're going to make more money sitting on your hands, being patient and waiting for those setups. You know, a lot of the setups I took last week, I was very patient. I waited for months to get those, but they still didn't work out. That's okay. Eventually they will. But Steve is right. Big profits emerge not from constant activity, but from patient waiting for the right time to act. Well, for me, this week was the right time to act. So I took some longs, right? I took some that worked. I took some that didn't work, but the ones that didn't work, I can get back in again next week if I get another signal. But big picture trading, like Steve says, be patient, wait for the right time to act. But when you act, then the second important part is then follow the process. So be patient first, but when you do act, you have to follow the process. All right. Thank you, Steve. I hope this was helpful for everyone, but yeah, you don't have to trade all the time. Just be patient and wait. And then when you act, more than likely, you're going to have, probability-wise, if you're really patient, you wait for that good setup. Probability-wise, there's more chances that you're going to have a winning trade than a losing trade, but there's also the possibility to have a losing trade. So you got to get out, right? Just like I do, and you can always get back in. So, all right, let us get over to the potential trades for next week. Okay, so we're going to start out on the daily time frame. And here I have 7 potential trades for next week. Now, I say this every week, but it's important. Monday, for example, if we had a big update, maybe all 7 of these would trigger. Does it mean I would take 7? No, I only take 1 trade per day. I only take 1 trade per day, and I have a scoring system. If it has 1 entry signal, I give it a point. If it has 2, I give it 2. If it has 3, I get 3. At the end of the day, I'm going to pick the 3 over the 1, right? Because there's a better chance that I'm going to have a positive trade if my trade has a higher quality score. So the way that I do this, and what I teach my students to do in my one-on-one courses, is to give a quality score to the trade. And what is what do I use? What do I incorporate as far as adding points or taking off points? First, how many entry signals? That's one thing to consider. Two, what's the risk to reward? Three, how does the market look on a higher time frame? Maybe it looks good on the daily time frames, but maybe it doesn't look good on the weekly. Or maybe it does look good on the weekly. Maybe there's a signal both on the daily and the weekly. If that's the case, then I give it another score, another point. What's the relative strength of the market? Or in other words, maybe the market's down on that day, but there's still buy signals. But maybe I have one stock that's up on the day while the market's down on the day. Well, the relative strength of that stock is stronger. And very likely if the market goes up in the future, it's going to go up substantially more than the ones that were down. Make sure, right? Does that make sense? So I give it a quality score. So if Monday these all trigger to the upside, I would narrow it down to one based upon multiple signals, multiple confluences. What's the risk to reward, higher time frame, and the relative strength. And again, this is what I teach in my one-on-one course. So, if you'd like to study with me, if you'd like me to teach you everything I've learned from my last 30 years of trading, it's available. Just send me an email, and I'd love to teach you. And I know you're going to be a better trader when you are done with this course. I've taught so many people from around the world, from absolute beginners all the way up to the advanced hedge fund level. So anyway, send me an email and we'll get the conversation started. So let's start with Amazon. So Amazon is interesting here. Technically, it did create a buy signal on Friday. Why? Well, it was a deep dip buy. It was a rejection of the 200-day moving average. Look, the 200-day moving average is 199.03. We closed at 199.25. So we did go below the 200 on the day and close back above it. And it's a very good risk to reward ratio. The RSI is 29.61. This is what concerns me. If this had closed under 30 and over 30, or gone under 30, over 30, and also rejected the 200, I may have considered it, but I didn't take it because, yes, it had one signal. It rejected the 200-day moving average intraday. But remember, what did I took? What did I take? I took the SPY instead. Why? Because it had a higher score. Sky not only went under the SPY, Sky is my dog. SPY went under the 200 and over the 200, but it also rejected the negative 30 ATR channel, and it had a V1. If we go back to Amazon, Amazon only had one signal where the SPY had three signals. See, that's the quality score I was telling you about. So I would consider getting long Amazon on Monday if we close back above the negative 30 ATR channel and also close back above the 30 RSI. Maybe we have a V2. V2 is 3 bars. Bar 1, bar 2. Bar 2 goes under bar 1's low. Bar 3 closes above bar 1's close. That would also bring it over the negative 30 ATR channel, and then it would have a higher quality score. Now, listen, we have to keep our minds open to the possibility that we could be down on Monday. Yeah, we had a bounce. We had a reversal on Friday, but we could go down again on Monday. And if we do, a really good spot, you see the green box? That's your bullish order block. And inside of that order block is the 300-day moving average, right? I don't just key off the 200. I key off the 200, the 250, or the 300. So if we were to go down on Friday and rejected the top of the order block and rejected the 300-day moving average, that would be an excellent spot. Really, I'm going to be watching that closely. Or alternatively, if it closes back above nicely and above the 200-day moving average and back over the 30 RSI, potentially get in there too. So for me right now, Amazon either has to go up more or down more. Ideally, I would prefer the down more. This bullish order block and the combination of the 300-day moving average would be a really strong, high probability trade. Doesn't mean it's going to work, but the chances are, in my opinion, that it's more likely to work than not, but you never know, so that's why you have your stops and position sizing and so forth. So Amazon either has to go up, close above the 30 RSI, or go down, reject the top of the order block, and or reject intraday the 300-day moving average. Let's go to Carnival. All right, Carnival's interesting. When I was going over the charts this last night, it's interesting for a couple of reasons. Now, I want to take you all the way back here to July 23rd, and also want to take you back to September 20th. What's going on there? Well, on July 23rd, this was the previous resistance, and we busted through that. So when you bust through a resistance, now it becomes support. And we have two areas of resistance. We have this one here at 1950, and then here was this high that we busted through at 1910. Okay, there should be some inherent support at both of these levels, both at 1950 and at 1910. So I drew the lines. Well, interestingly enough, look what happens, everyone. It's kind of magic. Those levels, those inherent levels at 1910 and 1950, they dovetail exactly, almost exactly, with the 300-day moving average and the 250-day moving average. So there is your confluence, right? You have previous resistance levels that were broken through. Now they become support. So there's support at the resistance levels from the past that also dovetail with major moving averages. So that is what I'm looking for. I am looking for CCL to go down. I don't think I'm too thrilled about getting back over just the 200, but because that's only one signal, right? But if we go lower, reject the 250, or even lower and reject the 300, then it's confluence. Then it's a major moving average with previous support levels. Okay, so that's what I'm looking for on CCL. Dow Jones, DIA. Okay, so I am short the Dow in the double leverage area, but this was a good sign on Friday. You see the green box. This is an order block. Here's your lowest bar close before market structure change, right? That is what an order block is. But we did poke our head in. We flirted with the high. We flirted with the high. And then Friday we went lower, but we ultimately did reject the high of the order block. Could I have taken this trade? I could have, but SPY was better with a better risk to reward ratio. This risk to reward ratio is not great because your stops all the way down here at the low of the order block. So, I'm short Dow through the double leverage DDM. However, if we were to come back down next week, a rejection of the 200-day moving average would be really a nice setup. One, you're at the 200-day moving average, and two, you're inside this bullish order block. So there is your confluence. So that's what I'm looking for. Gold, GLD. All right. Well, gold, I'm looking for a short. Why? Well, look, here's the red box. This is your bearish order block. Why is it a bearish order block? Because it's your highest up bar close before market structure change. We change market structure to the downside. Very often when you change market structure to the downside, you will have a counter rally before you have a big move down. So I am waiting. It got very close on Friday. I'm waiting for a rejection of the low of the order block here at 270.37. Now, if by the end of the day it closes in the order block, I'm not going to get short. I need the rejection first. Reject the bottom, reject the top, or maybe have a V1 or a V2 or some kind of bearish price action in the middle. I would also consider that. But I'm looking to get short oil on this counter move up after we've changed market structure to the downside. Intel. I've had some really good trades on Intel, and if you've followed this channel for a while, you know that I have. And again, this is an order block. This order block goes all the way back here to the 6th of August, right? We change market structure. When we get to the order block, we should bounce. We did bounce. When we get to the order block, we should bounce. We did. We get to the order block, we should bounce. We get to the order block, huge bounce. I took that trade. Well, look, we're back there again. We did reject the high of it. I didn't take the trade. But in the blue is the order block. Big picture order block. In the green, here is another more recent order block. Lowest bar close before market structure change. So we have an order block, a bullish order block within a bullish order block. This is what I'm looking for. I'm looking for a rejection of this order block. Rejection of 1941 or a rejection of 1901. So we'd have to come lower. I want to get lower in the big order block, and I also want to reject the intermediate or smaller term order block in here. So what I'm saying is if we kind of get close to 19 and bounce, that's where I would get long. And it would be very good risk to reward ratio as well. And it's worked every single time. It doesn't mean it has to work this time. Remember that. I want to be clear on that. But it's a good risk to reward ratio because I would get out if we had to close below the low of the order block 1885. So what am I risking? 40, 50 cents to potentially make dollars, right? And again, it rejected the higher order block already. So I could have taken this, but the SPY trade had a higher quality score, so I didn't. But that's what I'm looking for in Intel, somewhere in this area between like 1939 and 1895. Lockheed Martin. Well, nobody wanted Lockheed Martin. Now everybody wants Lockheed Martin. I'm looking for a short on Lockheed Martin up here. Red box, bearish order block. The low and the high of the order block, 491.10, 505.82. That's the red box. I'm looking for a rejection of the bottom of the order block around 490 or the top of the order block at 503. But if it moves up and closes inside, I don't do anything. I need a rejection. I need it to go to the bottom of the order block and fail. Conversely, if it heads on up, rejects the top of the order block, that would be my other or third. Again, if I have some kind of reversal, bearish V1 or V2 inside the order block, that would also be legitimate for me to short. So not shorting this yet. I don't even know if it's going to get there, but if it does, I will consider short. And last but not least on the daily is Philip Morris. So Philip Morris has done very, very well. You know, stocks like Philip Morris, Altria, Verizon, these have been safety stocks that money has been flowing into because the tech market and the other market has been going down. Well, you know, I can make the case technically that we are probably closer to the low than the high. Closer to the low on the indexes. And if we do rally from here, these safety trades most likely will come off. So I'm not just theorizing this, I'm basing this on technicals. Why am I basing it on technicals? Well, look, we had a high, we had a pullback, we had a higher high. This week we broke structure by taking out this swing low. This has now turned into a bearish market structure. What do I do with bearish market structures? I short rallies, right? So now that we've had this dip, it's likely that we could rally back up. If we reject the low of the order block at like 153.94, I might get short there. Conversely, I have this red line here in the middle of the order block. Why is that important? Because on this day, on the 4th, we had the big down bar day. If we rally back to halfway of that big down bar, that's an inherent level of resistance coinciding inside the order block. So a rejection of the bottom of the order block, I would consider getting short. A rejection of the middle of the order block at like 156.30, I would consider getting short. Or of course, the high of the order block, which is 158.85, rejection of that. That would be my ideal because then my risk reward ratio is better. So if we have a significant rally and reversal here on Philip Morris, I would consider getting short. So those are the daily time frames. And let's see what we have on the weekly. We're almost done. If you've made it this far, thank you very much. Well, you have a red box, so you know I'm looking for a short, right? Because here's your order block back here on 10.4. We broke structure to the downside in a big, big way. Now we are having a counter rally back up. If we reject the bottom of the order block at 65.18, I would consider getting short, or reject the high of the order block 67.43. I would consider getting short. So this is the shortable area. Where's my stop? Well, simply a close above here. If we break out and close above this high, then the bearish order block goes away, right? And we've had this huge, look, straight down, straight up. Is it going to get there? I don't know. I don't really care if I short Budweiser or not, but if it does get up there and reject, yeah, it's a legitimate signal. I'll take it. So I'm looking for a rejection of the order block next week for potential short on Budweiser. Russell 2000, which is the IWM. What do we have? Well, this is I think, the worst performing index. I am simply looking for a deep dip buy on the weekly of the 200-day moving average, the black line. Look, every single time we've got there in the past, here for 1924, rejected, up. Came back again, there were buyers there, up. We're almost there now. Is there going to be buyers this time? I don't know. Now, there's not a lot of confluences here, but if the one exception that I make for only taking one entry signal is on an index like the SPY, like the S&P, and the IWM. It's an index as well. So the 200 week moving average right now is $200.10. We're at 205.95. So next week I either have to bounce at the 200, go under during the week, close back above. That's what I'm looking for, is some kind of rejection next week with a good risk to reward ratio, because we could go down, reject, and then have a huge rally the rest of the week and then close up here. Well, I'm never going to buy that because the risk to reward is not good. So if I have a nice rejection of the 200-day moving average and a decent risk to reward ratio, I will consider taking that. Last but not least, everybody, Tesla. Uh-oh. My charts. Okay. Oh, okay, I got it. Here we go, Tesla, everybody. I had to get out of Tesla this week. I was wrong on the daily, but this is a very interesting looking buy on Tesla on the weekly. The weekly right now is 247.86. We're at 262.67. Next week, if we reject the 200-week moving average, I would consider getting long Tesla again, but this time on the weekly instead of the daily. And the confluence of this, there is a confluence. You see the gray line? That's the 50-day moving average, or 50-week moving average, crossing over the 200-week moving average. This is called the golden cross. The first move back to the 200-week moving average after the golden cross is a high probability trade. Doesn't have to work, but it is a high probability trade. And we are very close to that. So next week, if we have a bounce or some type of intra-week rejection of the 200-week moving average, I will consider getting long Tesla again. Okay, so that's all of them. Real quick, let's take a look at the indexes before we finish up. And let's look at on the daily, on the Qs. So look, we got very close to the 30 RSI. We did bounce in an order block. We did bounce at the 250-day moving average. These are all positive signals that a short-term bottom may be in. Really, but it doesn't mean. Sometimes the market's very difficult. It's not going to just let you in. But big picture here, one, we've had a big sell-off. Two, we're in a bullish order block. Three, we rejected the 250-day moving average. These are all decent signals. If I had to guess what would happen, maybe we bounce a little bit, but I don't think it's going to go straight up. I think what would happen is we might bounce for a week or two, then have a bit of a pullback, make a higher low, and then maybe we have a higher rally from there. Don't know, but that's what I'm thinking. But as far as the Qs go, we did bounce, reject an order block, rejected the 250-day, rejected near a 30 RSI. That is important. And then on the SPY, obviously, I think it's even a better signal because I took that trade on Friday because, one, we rejected the bottom of the order block. Two, we rejected the 200-day moving average. Three, we rejected the negative third ATR channel. So I don't know if I'm going to be right, but the signals are telling me to buy, and a lot of other people's are going to see those signals, but we'll see. And if these trades don't work out, I just got to go ahead and get out. So if you made it this far, everyone, I really appreciate you. I hope this was helpful. If it was helpful, if you could hit the thumbs up button, I'd appreciate it. If you'd like to study with me one-on-one, I have a great one-on-one course. Like I said, it's a 15-hour course. It's a 15-hour course. I do 3 hours each session, and then I do 5 sessions with my student. I'll teach you everything I know. Just send me an email. We can get the conversation started. If you're interested in the online course, I have the Deep Dip Buy online course available at udemy.com. The link's in the description there. That's also a good way to get started. If you have any comments or questions about today's podcast, just put them in the comment section. I'll do my best to get back to you. And I always like to leave off with, please try to go out and do something nice for someone. Try to do that every day. It would make the world a better place. You like it when somebody does an act of kindness for you. Why not do it for them? And if you could also, find it in your heart to try to do one nice thing for an animal each day, that's just good stuff. They appreciate it. It'll make you feel better as well. So God willing, I will see you next week. Please be careful. The market's very volatile. Follow your rules. And if you follow your rules, you'll be in better shape. But thank you so much, everyone. Appreciate you spending, and sorry about the really long podcast today. All right, take care, everyone. Have a good rest of your weekend. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.